Sponsored by Bangtak, Sustainable Business Development in Harmony with the Environment and Society.
Following the Thai government's recent incentives on investing abroad, Jones Lang LaSalle are among the many top foreign firms promoting overseas investment, specifically in the London property market. And now, as the Thai government is initiated the move to aiming to encourage Thais to invest overseas in an effort to soften the Thai baht currency, the leading multinational real estate firm expects wealthy Asians as a leading source of capital flowing into London's commercial and real estate market.
The Hughes. The Thai government has recently encouraged Thai investors to invest overseas, which may help soften the Thai currency. There are a lot of talks about opportunities for Thai investors in investing in overseas property market. What is your opinion on this?
Well, a lot of people are considering investing in property at the moment, and I think there's various reasons for it. One is that the equity markets have proven to be very volatile over the last couple of years, so that doesn't suit everybody. On the other hand, cash is not yielding much interest at the moment, so that's not very attractive. And the bond markets are also generally very low interest as well. So people are looking for an alternative as part of their overall wealth strategy. And an alternative as part of that strategy are the property markets of the world.
And what is the current situation of the big picture of the overall property market in the world?
Yeah, it's a big question. And I'll try and summarize. There was a very consistent trend in 2004, 5, 6, 7, which was the world property markets were booming, and they rose very, very quickly. And then, of course, at the end of 2008, the bubble burst, and prices fell almost uniformly all over the world. And since the end of 2009, different markets have been recovering in different ways. So if I take on one extreme the Tokyo commercial market, that rose very sharply, fell very sharply, and hasn't recovered at all. It's still bumping along the bottom. Whereas at the other extreme, you would have the office market in Jakarta, which didn't really fall in 2009, and since then has doubled as we stand today. So there are different markets doing different things, even just within Asia. But if I was to make a big generalization, in Asia, the markets have recovered more swiftly from the bottom of the market at the end of 2009. Continental European markets have recovered a little bit, but not that much because of the concerns about the euro crisis. Property markets in America adjusted very quickly down. Most of the pain is now known. Some markets in America have fallen by half, and there's early signs that the housing market in America is beginning to pick up again. That leaves the UK, and the UK is proving to be very, very attractive to international investors at the moment, both from a commercial point of view and in the residential markets. And I think there's various reasons for that. One is that London, for various historical reasons, is a very attractive marketplace for investors, particularly markets from investors from places like Hong Kong, the Middle East, and Singapore, where there's been a huge amount of money that's gone into UK real estate in the last 24 months. It's not in the Eurozone, so the pound or sterling is independent of that and seems to be taking on a kind of safe haven status at the moment. And because prices fell and are beginning to pick up again, so people from this part of the world think that it looks reasonably good value at the current time.
For Thai investors to invest in property markets overseas, which particular region should they consider first?
Well, I have to say that I would always have to answer that question by asking another question, which is, it depends what they're looking for. And people look to buy real estate for different reasons. Some buy real estate because they want a dividend yield. Rather than have money at the bank, not earning too much, they can buy a property which gives them a bigger dividend yield. And if it's that you're after, you would probably want to buy commercial property rather than residential. And you'd probably want to buy in markets like Australia, Japan, and the UK, where they're very transparent markets, they're very liquid markets, and you can get a dividend of something around about 5%, which is quite attractive for people, on the basis that they'd be presuming that there would be some capital growth to come as well. If you're a growth investor and you're looking just for capital gains, almost to speculate on capital gains, you might look at markets like Hong Kong and Singapore, where the yields are very, very low, but there are forces in hand in those markets that might mean that prices go up quite rapidly over the next 24, 36 months. So it sort of depends on exactly what investors are looking for. It's either dividend or income, in which case some markets look very attractive, or it's capital gains, in which case other markets look very attractive.
According to Jones Lang LaSalle, Asian investors have been increasing their investment to central London, especially the commercial real estate market. It is reported that the percentage of Asian investors increased from 6% in 2010 to more than 20% in the first half of 2012.
Meadows, why would you recommend Asian investors to invest in the London property market?
Well, there are a number of reasons why I'd recommend Asian investors to invest in London. One, it's a very mature market. It's always attracted international capital. So there are relatively low barriers to entry. There are no restrictions on foreign ownership, for example. It offers very good risk-adjusted returns, both in the office, retail, and residential sector. I think probably the other big reason is, London is very much now a global city. So when it comes to tenants, whether they be office tenants or residential tenants, there is now a very broad cross-section of tenants that occupy buildings in London. And as a consequence, I think international investors are attracted to invest in a market that offers that sort of characteristic.
Right. Now moving on to another question. Where is London now in the property market cycle? Are prices going up or down?
Well, if we take a step back and see what happened both during and after the financial crisis, the peak of the London market, like many other mature markets around the world, was around 2007. During the financial crisis, obviously London was not immune to the shocks that were going through the world economies. So we saw rents fall sharply. In the case of, for example, the office sector in the West End, we saw rents reduced by up to 40%. We also saw investment volumes, transactional volumes, drop sharply as bank lending froze and investors took a wait-and-see approach. But the market recovered very, very strongly. So there was probably only a period of 3 to 6 months in 2009 where there wasn't liquidity in the market. But largely due to international capital, more recently led from Asia, we've seen a very strong recovery in the investment market in London. We've also seen a good recovery in the leasing markets in London as the tenants have recovered from the financial crisis. So where are we today? I think we're into a period of recovery. We have obviously seen continued volatility in the Eurozone. So in the last 12 months, some of that rental growth and tenant demand has slowed, particularly in the financial services sector. But generally speaking, we believe we are in a phase of continued recovery.
And which property sector is most attractive for investors when investing in London property market?
Well, I think, as always, that depends upon the type of investor. What we have found from Asia is that those investors that are looking for yield, they're looking for dividend returns, income returns, have tended to favour the office market. London, one of the big features of the London commercial office market is long-term lease contracts, often 10, 15, even 20-year lease contracts. That offers very long-term secure income, and so we've found that investors, particularly some of the pension funds from Malaysia, like EPF and PMB, have favoured the office sector because of that long and strong cash flow that the office sector offers. However, we also see demand across the other sectors in the market. The hotel sector, for example, a number of Asian investors who also have hotel operations have been quite active in the hotel market. Residential has been particularly strongly sought after from investors in Asia, whether they be buying individual units, possibly for their children who are at school or university in London, right the way through to investment blocks and possibly also joint venturing with London developers on major residential developments.
And what is the range of investment yields that investors can expect?
Well, in the commercial office sector, probably best to split the London market between the West End, so office markets like Mayfair, St James, Victoria. The net office yields will range between 4 to 6%, depending on what the asset is. If we then move across to the city, the downtown financial district, the yields will probably range more from 5 to 6% in terms of prime yield. So it depends on what sub-market you are looking at in the market.
And should investors buy these properties and put them up for rent or hold them for some time, then sell them to make profits?
Good question. I think that our view is that you should look at London as a longer term hold. Clearly, in Asia, we're seeing far greater economic growth, possibly far greater short-term opportunity to make profit from development and property activities. London should be seen as a longer-term hold. So our view at the moment is if someone is coming to buy into the market today, they should take a 5 to 10-year view in terms of holding for that period of time before thinking of selling.
We'll be back after a short break to see how Mr. Meadows have to say about a surge in the inflow of Asian capital, the issue of foreign ownership, and the risk of investing in the property market.